What are market cycles? Market cycles, also known as stock market cycles, is a wide term referring to trends or patterns that emerge during different markets or business environments. During a cycle, some securities or asset classes outperform others because their business models are aligned with conditions for growth. Market cycles are the period between the two latest highs or lows of a common benchmark such as the S&P 500, highlighting a fund's performance through both an up and down market. Key takeaways. A cycle refers to trends or patterns that emerge during different business environments. A cycle time frame often differs for each individual person depending on what trends they are looking for. A market cycle often has four distinct phases. It can also be impossible to identify what phase of the cycle we currently in. At different stages of a full market cycle, different securities will respond to market forces differently. How market cycles work. New market cycles form when trends within a particular sector or industry develop in response to meaningful innovation, new products, or a regulatory environment. These cycles or trends are often called secular. During these periods, revenues and net profits may exhibit similar growth patterns among many companies within a given industry, which is cyclical in nature. Market cycles are often hard to pinpoint until after the fact and rarely have a specific, clearly identifiable beginning or ending point, which often leads to confusion or controversy surrounding the assessment of policies and strategies. However, most market veterans believe they exist, and many investors pursue investment strategies that aim to profit from them by trading securities ahead of directional shifts in the cycle. Understanding the stock life cycle is an important element in interpreting the performance of a fund. Everything in nature goes through a cycle, whether it is a living organism or weather. Like living organism passes through different phases of birth, growth, maturity, decline, and lastly death or rebirth. Weather also follows a cycle, and there cannot be one season throughout. Summer season is an unavoidable part of the weather cycle, and it's going to stay with you for some time, around 4 to 4.5 months, whether you like it or not. Then it is followed by the monsoon. In the same way, the stock market also follows a cycle. After a bear phase, it will be a bullish phase, but however, no one knows exactly how much time it's going to take. If someone wants to enjoy the fruits when the situations are conducive, it's important to adapt to harsh phase by being adaptive to the environment. The key here is patience. Different phases of a stock life cycle. Phase 1, accumulation phase. The phase is generally seen either in the early stage of a new company or after a prolonged decline in the stock price of an established company. After a period of advanced business conditions, the company tries to reorganize during this period. This period may last from a few months to many years. The stock here is largely held by owners who don't have any intention of selling until they realize substantial profit. The stock may move in a range during this period, and strong resistance develops at the top of the base area. Any breakout from the base area signals the stock has entered the second phase. Phase 2, growth phase. With the improvement in the business condition of the company, the stock often breaks out of the long base and enters the growth phase on increasing volume. The steady improvement in the business conditions and the entry of new investors who bid up the price to obtain stock reinforce the uptrend. The stock price remains above its 200-day moving average in the phase, and it's better to remain invested in the stock until it holds its 200-day moving average. Phase 3, distribution phase. The smart stock owners know that a good times cannot continue forever, and the stock becomes highly overvalued during this phase. In the background of rosy earnings and good economic news, the stock is often distributed to small investors. The top may range from several months to a few years, and the price may be more sideways during the period. An early sign can be in the form of price breaking below its 200-day moving average. Phase 4, declining phase. When the stock enters declining phase, initially there will be any apparent reason for the same. Gradually, the bad news and evidence of determination will lead the price to further lower levels. In between the fall, there may be some short-term false up move in the investors may believe that the price has bottomed out. One should be careful during this period, and rather, as the stock price approaches its 200-day moving average, it may provide a good shorting opportunity. How long is a market cycle? Cycles in the market tend to have cycles lasting 6 to 12 months on average. However, fiscal policy in either the United States or the world can be widespread effect on the length of a market cycle. The average is 6 to 12, but it is an example. The Federal Reserve were to drastically cut interest rates, it could prolong a market trending upward for a period of years. What are the four market cycles? Again, the four phases of the market cycles: the accumulation phase, the markup phase, distribution phase, and the downturn phase. The first two phases could be considered mirror images of the other. Accumulation is when investors and businesses are scaling back in the market and increasing their exposure, whereas distribution is the opposite and is the period when the investors start shaving exposure from their positions. Markup is an increase in prices, while downturn is a decrease. What is a market mid-cycle? A market mid-cycle occurs when the economy is strong but growth is moderating or slightly slowing. Corporate profits are delivering as expected and interest rates are low. This tends to be the longest part of the market cycle. Bottom line, the investors often look at solid fundamental reasons before investing in a company, but one drawback of this approach is that the time they have supportive evidence, it's already priced in accordingly and the stock has already moved by a good percentage. The market has already discounted the positive news. Look to buy a stock when the stock is surrounded by bad news and nobody wants to buy it. The weak hands will try to exit the position on such news. On the other hand, after a good uptrend, the picture looks rosy and the smart investor exists. Their position and offloads their stake to weak and news-driven investors. We are a big believer in the market cycles. And if you can figure out what market cycle the macro in or what market cycle the sector is broken down into the individual securities, it is much easier to become a trader, investor, or whatever you are doing. Market cycles are very important to any investor or trader in this market. You know the catchphrase: study it, analyze it, adapt it. Peace.